Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market, and I'm your host, Kevin Horner, joining you from the comfort of my home studio here this morning. Pleased that I'm chatting up with all of you today, obviously, after a rough Wednesday. I hope your afternoon was better after the market closed. I don't know about you, but I kind of tend to step away from things when it gets a little bit ugly, and yesterday certainly led to a walk away at market close, and it was good for my mental makeup. And today we're getting a little bit of a bounce. We're going to talk about some levels achieved yesterday with the selling, and we're going to look at some of the forces behind it, as we always do. So with that, we'll get down to business this morning. I'm joined by my friend, fellow Schwab coach there, Ben Watson, in the chat. Say hey to Ben this morning, who will get to comments and questions that I'm unable to, but I always try to keep an eye on what's happening there in the chat. You guys do a great job of keeping each other engaged and also answering each other's questions along the way where Ben or I are unable to. So we really appreciate that. That community of engaged traders here is what makes Trader Talks as a channel so special for all of us. So thanks for being here this morning, everybody. Remember that you can follow Ben and me on X, Ben Watson CS, Kevin Horner CS. Great spot to find us here when we're not online with you chatting about the market. So find us on X and extend the conversation there, you know. So with that, today, let's get down to our disclosure so that we can move to the charts. First of all, remember that everything we discuss today is considered informational and educational. We're not here making recommendations nor endorsing a specific approach to trading the market here. What we are considering and offering up are concepts and strategies of technical analysis that traders might choose to employ, but we're not encouraging that. What we are encouraging you to do is to kind of do your own due diligence here, dive into some of these concepts and strategies, find what works for you, and then build your own process, your own plan, and try to stick with that as best we can. So technical analysis is a decision-making piece to the puzzle, so to speak, but it is not the entirety of it. So try not to base decisions exclusively off what you get in the way of technicals. Our agenda here on a Thursday remains pretty consistent. We will follow our top-down approach, hitting up the SPX, the Russell 2000, the NDX, the NASDAQ 100, that is. Got to look at semiconductors under quite a bit of pressure of late, and then we extend into some sector groups just to get a little clarity on what's happening. And of course, today we're going to look at oil a little more to see if we can learn something about what might be on the horizon for us as we go forward a little bit. So with all of that, let me bring in the Thinkorswim desktop application, and we're going to peek in on the SPX as we get started. So there's that pretty rough candle we saw yesterday. I'm going to go back to our lows in late March and zoom in here. And our low yesterday, less than ideal, of course. We had been discussing how we've been below that 50-day moving average, 20-day moving average confluence now for what today is day 6. And, you know, this is not exactly what we're looking for, of course, but we would love to see us get a bit of a bounce. We could certainly remove my drawing here. And, you know, you often hear us say you can manually draw your trend lines. And the great news about a manual trend line is you can always alter it and redraw it and make it look a little bit more pristine as we go through and add more data points. But, you know, the takeaway here, this is still slightly higher than this low, and this is still slightly higher than this low. I think we've got a broad range of horizontal support in this area going back to the gap from early May, and it would maybe look like this approximately. So this could be an area of short run horizontal support, a band of support, not necessarily a well-defined flat single line that is so you know, to the penny by any stretch. In fact, you know, I don't encourage you to utilize values that are to the penny necessarily, but we do like the idea of using a range because it can remind us that these moves often get into support trade through support to the downside, then get some level of exuberance or buying coming in. Commonly we make intraday lows that are then bought up, and it's important that we look for closing valuations along the way as best we can. So we're going to monitor that area. It's always appropriate here to maybe give thought to, can we validate any of this area of support from a Fibonacci sequence standpoint? We don't mind giving back 2/3 or up to 61.8% of a rally, and we can go back to the last push that we made here. We've been doing this a bit over the last few months to see if we can get any understanding of what might be coming, and you'll see, guys, we have not really given back a majority of this move, have we? We're still holding on, even with yesterday's low, the 23.6% retracement level. That's the very first one. So, look, to say that the weakness was okay yesterday, no, nobody likes the weakness. We know that, especially when it gets aggressive in our biggest, most growth names, and the names that many of you are familiar with and maybe even trading quite extensively. But context is always important, and perspective is important, and the reminder that we've barely given back about 23% of the rally we've had since early April kind of puts that perspective out there for us. So something to keep in mind as well. Sure, we can do that for you, Rita. I'll put up the 100-day. We remain a little bit above it still, so I'll back this off. Let's go back to there's the 100. It actually resides beneath us still, beneath my area of horizontal support. And so depending on your process, maybe you're a 100-day trader, maybe you're the 200-day trader, maybe you're the trader who says, hey, I actually prefer all of this in the weekly viewpoint. And in the weekly, boy, it sure looks like a very consistent, whoops, I was going to zoom in there for you guys, very consistent uptrend, right? A very obvious series of higher highs and higher lows along the way. So what we're getting, never fun, right? We know that weakness at any point isn't fun for the traders who are trying to maintain short-term momentum, but it's a great reminder that the market doesn't do what it was doing from April through mid to late June for the entirety of those windows. We do get some fits and starts. We're going to get pullbacks that are healthy for the market and healthy for us, and our job is to try and manage that along the way. Now, if you are the investor who's watching all of these moves and saying none of this is consequential to the way that I manage my portfolio, then terrific. You have an emotional, or I should say is a lack of an emotional tie to your process. This is really good if you're managing what's gone on today and maybe even for the month of July, and simply saying all of this back and forth, this consolidation, this lack of new highs, this is not a terrible thing for me. If that's what you're saying, then you are probably a comfortable investor who is simply allowing themselves to ride the waves of the market and going forward with an idea that says, get invested, stay invested, and keep feeding that investment plan, which for a long-term investor is a process that many investors do work with and do stick to. So as always, try to be comfortable along your process as best you can. But we do what we do here on a day-to-day basis to kind of work our way through some of the noise that happens. And it's true that on a day-to-day basis, market movements are often considered not much more than just noise. It's those longer, broader trends that can really define what the market's up to. So okay, so the S&P, we got some levels to keep an eye on. We do know that there is a good band of horizontal support down here at the prior highs, right? Remember, prior highs as resistance can at a time down the road act as support. So if we were incapable of maintaining our 7250 approximation here on the SPX, we would have to at least be prepared that the opportunity exists to revisit that 7,000 level. We're not at that spot yet, haven't made new lows, so we're just simply preparing for the instance because we don't know what's coming. Okay, let's check out the NASDAQ. Getting a good start today, up 2%. I'm going to go ahead and put back all of my major moving averages. We're likely to see that 20-day moving average in orange act as a little bit of resistance for us, given what we have been witnessing of late. We're about 2 weeks, 2.5 weeks under that 20-day moving average. You'll notice that we've gotten a bit of a waterfall move to the downside here. We broke down, not uncommon at all to see the way that this worked, right? Because once you break down through an area that had been support, then you're often going to bounce right back into that area for a test of former support potential resistance. And that's what happened. I'm going to draw it in and going to try to draw this in for y'all as I'm getting just a little bit of a lag here, but that's really what I'm talking about. This bounce here was very short-lived. 28,200 bounced up to 28,850, 28,900, or excuse me, 29,200. So bounced about 1,000 points in the NDX, and yet it didn't go anywhere. We ran into the 20-day, rolled over. So the 20-day, from a trend following standpoint, is apt to be an important level that the NASDAQ is going to need to recover before we can start getting back into trend. And if you're looking for something a little speedier, you could, of course, utilize perhaps the 10-period moving average. So let me clean that up and let's go with the 10-day here. There's where the 10-day resides. And honestly, boy, that kind of calls out some levels, doesn't it, everybody? Look at those extended tails that we had recently. Those extended tails were support. Well, now they could be resistance and confluence with the 10 period. So if you're looking for an early entry signal potentially, it might be a close over the 10-day. Now, how do we consider that again as traders? Well, for many of us, because again, we don't know if the bounce is legitimate when we get a day over the 10-day moving average, but in order to validate that, many traders will step in with just a piece and see if they're right. And if they are in fact right, by virtue of staying above the 10-day moving average for another day or a third day or even longer, they may then add to a position that they create from such a move. So you can be early to these moves. The encouragement might be to be early and be smaller position size, because early means less reliability, right? If you wait for confirmation, chances are you're going to be more likely accurate in your time frame or in your window to devote money to the market, but at the same time, you're certainly not catching bottoms, right? And we don't try to catch bottoms. We don't try to catch tops. That's not really the plan here, recognizing that that is a scenario that many traders think is out there, but it's really uncommon. So we're not striving for that. We're striving to pick up the meat of every move we can, which is to say the portion of the move that maybe misses the first 5 or 10% and misses the top 5 or 10%, right? The ending 5 or 10%. It's okay to make the meat of that move the rough 75, 80% or more of a move without getting the absolute bottom or absolute top. So keep that in mind as well. So yeah, we've got a little bit of a repair situation underway with the NASDAQ today. We'll start to feel a little bit better back above that 28,200, and that's a level we're going to keep watching here on the NDX initially, and then if we can clear that, we're going to start talking about that 20-day in orange. All right, so let's see how the Russell's reacting today. Yesterday, Brent and I were talking about how the Russell was showing some relative strength. We had held in to the 50-day moving average, and then that all gave way yesterday like a bit of a dam break after the announcement of the Fed's holding steady for the period. But it wasn't so much the Fed holding steady that spooked things as it was the 3 dissenting votes to hold steady. The expectation being that they're now getting closer and closer towards comfort with a rate hike between now and the end of the year. Now, there's plenty of speculation about that. Of course, we try not to speculate, but we tell you what traders are positioning for. And it is true, traders are in fact positioning for a hike or even two, 50 basis points higher than the current Fed funds rate. But I'll point out that the traders of Fed funds futures are not right 100% of the time by any stretch. In fact, quite often wrong. But at the same time, we've got a Fed who's going to choose to be, and has told us they choose to be, a little bit less transparent. They don't feel it's important for us to know every thought of the Fed along the way, and that lack of additional context from the Fed could keep us a little bit on edge, to be quite honest. We're not going to have as much detail or knowledge, perhaps, of what's happening here. So at least not the Fed's underlying thought process necessarily. So we kind of have to parse more of the detail of the market, and we have to make our own assertions here. So the Russell's move. Hey, look, the Russell's been a bit of a leader, and right now we would like to see would be yields kind of reacting and pausing, or at least calming a little bit. But you can see that today it's going to be a challenge for us to get anywhere outside of yesterday's candle. Can we get above yesterday's high? Can we get below yesterday's low? It's most likely that today finishes in between yesterday's action. So we're likely to get an inside day, not necessarily a decisioning day, if you will. And if you want to be bullish, we got to get above yesterday's high on a close. And if you want to see some continuation of the weakness, then you want to get under yesterday's low. Pretty basic approach here to what's happening. Now, today it's also notable. We heard PCE detail this morning, which came in a little cooler than expected, but it should be noted that that cooling on the PCE figures, and as a result of is a result, of lower oil, but it's also lagging in its information. So I wanted to bring up the chart in oil today. So we're going to use the future symbol here. We're going to look at both oil. We're going to look at oil. We're going to look at gasoline. We're going to look at diesel as well. But I'm using the future symbols for all of these, everyone. We do that, of course, because this is how we track price and trend, but it is not an advocacy in any way for futures trading, and that does carry a higher level of risk. It's certainly not appropriate for all of us as traders, but for those of you who are interested, our man Ben Watson here teaches a futures class on Tuesday mornings in lieu of Trader Talk. You'd be welcome to join him live for that on Tuesday mornings. A great kind of introductory conversation, if you will, to futures trading, some areas of the market that can help you out to keep an eye on pre-market as you're kind of setting your own table, so to speak. So we're going to look at oil here. The areas of most note, I think, for a lot of traders, at least from the trend standpoint, is going to be that downtrend line off the peak. We've run to it again, failed at it again. Now, however, we've made a higher low right here, working off the 20-day moving average. That's going to bear watching. But the interesting aspect of this, as I see it, is the PCE giving us cooler sentiment because, well, for the month of June, what was happening in June? Oil was dropping from 96 to 66, or what was the low here? 67, excuse me. So, a minor 35% pullback. That's a wonderful move and a positive for the PCE. However, what has happened in July? Well, we've seen the exact opposite of that, everybody. We've seen a pretty healthy rise. And if we took out, the move just to the peak there, we see we're up about 40%. Now, it's not up there right now, so that's notable that we've sold down a little bit. But the bigger issue isn't necessarily broad crude prices, but the price of gasoline, and maybe more specifically diesel. So let's look at a couple of those symbols as well, because this is where the input charges and input costs can increase dramatically and create a worsening inflation story, unfortunately. So let's look at gasoline, which we're going to use symbol RB. Same thing applies, a future symbol here. So this is the gasoline futures on the one-day basis. We are seeing a deeper pullback. This is good. However, look at where it's pulling back to. Right to that confluence of support and 50-day moving average. Now, the technician in me makes note of the fact that the 50 period moving average is down sloping, and that means that it may not be as comfortable for support. Maybe it leans a little bit like we could fall through this level, and that wouldn't be terrible for us, obviously, at the pump, right? We would like that, and that would be good for us as retailers. But the bigger monitor, I think, is on the heating oil. And remember, heating oil is often used as a bit of a proxy relative to diesel. It is the heating oil contract, but we frequently will utilize it because it represents ultra low sulfur diesel specifically, which does give us that lean towards diesel and big. Think about it, the cost of moving stuff across country, which is done with, of course, the semi-trucks, broadly speaking. So that gives us something to keep in mind and watch here, because as diesel oil or heating oil / diesel remains elevated, that is absolutely an input cost that can elevate inflation, right? So oil broadly, crude broadly, but maybe more importantly, the view of the heating oil specifically as a proxy for diesel and gasoline futures can be a little bit insightful for us. Now, the thing that stands out to me about this chart as I zoom in is the technical aspect of it. You all know how frequently we see this. The broken downtrend line leads to a new uptrend. This is the concern that I think traders and investors are watching right now, is that we've got a crossing 20 period moving average upward through a 50, trend change in the short term. And if we are going to see trend change in the shorter term develop into intermediate term, well, we may very well expect the trend in diesel to keep climbing. Now, obviously, I don't want that to happen, because I would prefer to see, as an investor, a trader, I want to see cooler inflation, not hotter inflation. But this is not necessarily the setup that we want to be finding right now. So we're going to keep an eye on it. We're going to keep watching it. But unfortunately, as you all know, this doesn't tell us necessarily what's coming. It just tells us some areas that we got to keep an eye on, and that could give us insight to potential for the next range, the next opportunity. Now, the takeaway today is that the PCE did come in cooler, and the markets like that. But be prepared that subsequent PCE details may not continue this cooling trend due to some of the elevation we're seeing in crude, in retail gasoline, as well as heating oil / diesel. All right, so that's the takeaway there. All right, let us peek in on our semis, which got absolutely crushed yesterday, but we are getting a lovely bounce back, 7% bounce back. Now, my chart is showing us the Fibonacci retracement off of this move. Boy, if today's candle holds and closes like this, it's going to look relatively favorable for us, everyone, because it looks like an exhaustion move yesterday. But boy, again, we've got to get through some of these very short-term levels. So it's nice that we're up. We like what we're seeing, but this needs some continuation, okay? So let's try and be relatively optimistic, but without too much aggression, right? Again, if you're the trader who believes that this is the time to get into positioning in semiconductors, well, I'm going to once again encourage a smaller dabble, right? Not because I expect that what's started today won't last, but rather we don't know if the rally that we could be getting is merely a relief bounce into resistance once more, right? Is it the 20-day down sloping? Is it this 38% retracement on this move that could now act as some semblance of resistance? Yeah. There's nothing wrong, Duke, with being cautiously optimistic. I like in bringing caution to these moves merely because it likely means that we're not overdoing our process, right? We're not over-investing just because we reached a certain level. Again, I think it's far more important that we manage our own emotions along the way than it is that we evaluate the trend spot on, because chances are we're not going to be perfect in our trend evaluation necessarily, but we can be perfect in our management of our own emotions, since that requires us just to basically, set the rules and then stick to the rules, right? It's easier to manage ourselves than it is to manage the market, probably. So at least that's what I found, and again, I try to do that as much as I can, just through proper positioning sizes more so than anything else. So yeah, nice little bounce here. Let's take this into the hourly charts real quick, and let's see if we can find. Okay, so this is a good reminder of what can happen here on these hourlies. I'm gonna go into my gear. I want to make one minor change to my. Let's see here. I don't want to see extended hours. There we go. So now everything's a little more clean. There is our 20-day moving average oval on this chart. And, this is a nice short-term development, what we're looking for. Above the 20-period exponential moving average, one that some traders will look for for defining shorter-term trend. And you could see that yesterday and this week, really, SOX has been moving lower, and we've been below that 20-period EMA the whole time. So the fact that we gapped aggressively above it is a good step in the right direction, but we just need to see some continuation there. So good starting point for us. And if if you were looking for short-term trend management, I think bears would be very excited if they saw us back below the 20 period, and you bulls probably very uncomfortable back beneath it. Doesn't mean we're going to see that. Certainly has the makings of a bounce type day under given the move that we made yesterday late following the announcement, and then of course the aggressive selling we got felt a little like capitulation, but we're going to see how that plays over the coming couple of days. Still looking for more confirmation than anything else, but a wonderful start today, up 7.5% here on semis. Now let's go ahead and move into our Market Watch page. Let's take a look at our basic quote functionality here. So I'm going to go into my sectors and industry groups. There we go, sector indices. Now see all of my, let's see here, do I have them in there? There we are, Market Watch. There we go. Okay, so by the way, everybody, since I'm doing this, I just want to highlight the functionality here real quick. A reminder that you can maintain different column settings in your, whether it's this Market Watch quotes page or your traditional market watch list over here on the left. This is absolutely a nice little updated function of late. So set up your columns different. If you are the trader like me who sets different columns for different things, then make sure you do it and define them, give them a name so that they're easy to locate. Here I'm just going to kick this back to my standard Market Watch return detail, which incorporates change for the day, the year-to-date change, 5 and 20 days and 6 months, along with my relative strength, as you can see. But this is very different than what I have over here on the far left in my gadget zone, where I'm working with a standard watch list. So, just a little reminder of the nature of this tool and what you can use it for, what you can do with it in terms of your own customizations here. Now, today, I saw some of you pointing this out. If we look at the change, where are we getting the bleed today? Well, from some of those that have been doing really well. So we're seeing staples selling down. We're seeing healthcare taking a little bit of a breather. We're seeing energy pulling back with oil pulling back a little bit, and financials. Financials kind of flat, actually. But we're getting the biggest pop here in tech. Let's take that look at the visual side of things here. Open up the S&P. And let's look inside tech and see if we're getting that. Okay, so we're actually getting a little bit of a, software is kind of moving a bit. You've got a 50-50 move in software, so it's kind of a hit or miss. It seems like it's a maybe a picker's choice here in which is to say in software it's not entirely software. And so, as always, I like to remind us that we don't have to view everything from the 11 sector basis. You can drill into each individual sector and see where leadership is coming from, you know. And so, if we looked at software, yeah, Microsoft and Oracle doing really, really great today. Those are very bright green colors. But you got a few that are lagging there. Obviously, your Intuits, your Autodesk, ServiceNow, and so on and so forth. So, some reminders of some of the tools available to us here. Let's look at some of these in the way of the charts, though. So let's lead with that leader today. How about the tech? So a great bounce today with a wonderful gap, and yet haven't done anything to fix the trend, have we, everyone? We've got a pretty clear downtrend, whether you want to draw it from the peak or not. I like this. I feel like this line just feels a little more consistent there. Lower highs. We know what we got to do, everyone. We've got to get technology above the downtrend line, or we got to get above the 50-day moving average, where we're going to feel a lot better about the trend reestablishing itself. For context, back this off into the weekly, and man, does that look a little different, doesn't it? That is the 20-week moving average right there, everybody. So that's kind of interesting that we're bouncing right off of it. It's an notable the amount of buying now today. Now, of course, on a weekly chart, it's only Thursday. Tomorrow's going to have a play on this, but this is kind of a relatively positive view. You could also duplicate that line and draw in the flag, and it sure looks like a pretty stellar bull flag off of the April bottom, doesn't it? So a wonderful pattern here. Now, for fun, not because we think it's going to do this, but rather just to give an idea of what a break of a bull flag may look like over an extended period. Let's draw in the flagpole, and let's be conservative. Let's just take it to the closing high of the big week there, and then we'll duplicate that line. We'll add it to the bottom of the flag. I'll duplicate it again, and I'll add it to the top of the flag. And then that gives us, of course, an approximate range. Now, as always, I remind us, when we do measured moves, never are they a guarantee to be achieved, but this is a way that traders might start to set targets on a potential breakout. And obviously, we are not through that flag to the upside, so we can't start targeting that anyway, but this is why we draw the lines. We want to know what is possible given the potential for a breakout. Do I know that that's going to happen? I don't. But I'm hoping, obviously. I'm not taking position based on hope, but I am drawing in those lines. I am thinking about what could occur so that if it does in fact play out that way, I have already given thought to this, right? I've got those ideas in the head that say, yeah, I'm going to be a buyer here, whether that's a full position buyer or a partial position buyer, up to you, of course. But this is the idea that a lot of traders will bring to the table. Right, let's draw those lines, let's make some assessments, and then let's see if the market gives us what we think. And beyond that, of course, what if it doesn't give us what we think? How am I going to act then? What steps will I then take? All right, so this is a really nice development for tech, and she's right, Lakshmi, you know that. Yeah, of course. Hope is not the reason we trade. We hope that we're going to get what we need to take action in the market. We know we don't take action based on hope, though. That's the truth. You're absolutely right. All right, so there's a look at tech. Now, what else moving here today? We know energy pulling back a little bit, but remember that while energy may be pulling back, as long as it maintains above the downtrend line that we broke, you have every reason to think that energy is in a short-term uptrend. Look at the 20-day catching up into here. 20-day crossing the 50-day to the upside. Again, we know that if oil gets pushed lower, if we get to a point of conflict becoming less worrisome, we're going to see oil lower, which would be positive and would likely lean heavier on energy, and it may break the short-term downtrend, but it's not broken at the moment, so got to keep an eye on it. We'll work our way down here a little bit. We've got discretionary. That's a not so great look, is it, everybody? That's a big breakdown this last week and a half or so, building a bit of a I mean, I guess it could be building a bear flag in here after a big significant breakdown. Discretionary though, just really not trending the way we would like. It could be considered to be trending sideways, I suppose, but it's a pretty broad range and it's been a little more volatile. We're getting a pretty good sell-off here in Staples after a big rally. Boy, what a fail, huh? Up here at resistance. Intra-period failure right at that ledge, and now we're back into the zone. And again, I think what you're ultimately seeing here is a pretty wide range in Staples. So that probably not a whole lot going on in Staples outside of the range necessarily. Let's take a look at what's further down the list. Here's healthcare, which we've talked about having been so strong. Now what we've seen was a bull flag break to the upside to new highs, and that move to the upside on new highs pulling back to the 20-day moving average. Now, it's notable that the 20-day hasn't been perfect. We've definitely dabbled beneath it, but that doesn't mean we are having to get under the 20 here, but certainly interesting, right? So this bull flag here, if I could draw that, if it's going to take my cue to do so, please. There we go. There's one line, there's the other. So you can see, I mean, it's a beautiful bull flag. Pulled back for 2 weeks, held the 20-day and made new highs. Now we're breaking back to the 20-day for a support test, hopefully. That's what you're looking for as it relates to healthcare. But we shouldn't be surprised because so many of you that traded healthcare to the upside probably looked at the selling in technology and said, boy, great opportunity resides in tech here. Let's take a little bit of profit with healthcare trades of late and see if we can get into some of those laggard technology trades that have been beaten up of late. So, not uncommon. On a day-to-day basis, these are relationships we will often see. Okay, let's Staples. All right. There's your financials, everybody. Financials still looking pretty stout. That 20 period, look at how long that 20 has worked, everybody. You all remember we've been talking about this for a while, mostly going back to when we broke the 20-day here. The downtrend, the channel was busted cleanly with a big gap on April 8 with the rest of the broad market. That was a real nice tell. And since we've more or less held the 20 since the big move here back in June on the 4th. So now you're looking at almost, my goodness. Anybody else shocked that the end of July is here? I mean, it's over, everybody. It's over. Summer is just about over. I'm always bummed when that comes to the table. I just can't believe that we are 7 months through the year already. But again, 20-day moving average providing support. We've been seeing bull flags beget bull flags, right? There's one bull flag. You had another quick one that was resolved to the upside with new highs. Then we tested the 20 again. Bull flag breakout to the upside, trying to come back to the 20 once more. I mean, this is a consistent pattern. Is it getting tired? I don't know. Could we see the 20 continue to provide support? Yeah, we sure could. It could persist even longer, but we just don't know. So, management, given what we've seen being above it since June 5, we're at 8 weeks almost, this is an area where things could change. And under the 20-day, traders would perhaps consider that a change in financials. So we'll see how that plays. But right now, looks like confirmatory in nature. And for those of you that have been participating in this class for quite a while, you know that we've been talking about it all the way back to April, how there was an improvement in this chart. There was an improvement in that healthcare chart. And we wanted to see how that was going to play out. And it's certainly played bullishly in the near term here. So we'll be keeping an eye on it. Let's look at communications. Just getting more of the same. Now, the trouble with communications, as many of you know, is the nature of communications. It is not a huge group, fairly small, and look at the size of the big boys there, everybody. Meta and the two alphabets, and then your Netflix and Disney. This is a group that is largely driven by what Alphabet and Meta do, but all of the group in the red today, more or less. It looks like we've got EchoStar, Dish in the green here at the moment, but that's about it. And the trend on this one feels kind of rough. We're about, boy, how about that bounce, everybody? Bounce into the 20-day, roll back over. Now, if we're looking for some positives, the big positive here could be that the lows we've made over the last week and a half are the same lows, and we've got a bit of an improvement here in the RSI. You do have the last extended low back here in late June was at the 30 line, and then these lows are above the 30 line. So we are getting a bit of a bullish divergence with the RSI, but you're not in new trend just yet. On a longer term chart, I'd venture to guess that this looks like more of a standard pullback, but let's just take a thank you for your patience, everybody. White Fang, I am laughing at your comment. Yeah, speaking of communications, yeah, looks like we had a little hiccup there. So as I was saying, we're just watching the potential for communications to see additional weakness in here. Still a higher low on the long range setup, but boy, if that 100-week moving average came into play once more, it would be painful. That's another about 10% down to the 100-week moving average on communications. Now, I wanted to spend our final couple of minutes, as I often do, in looking at equities. And, you know, today I did have an upgrade in Bloom Energy that I thought we could check out, BE. You know, Bloom is like just many of the stocks here. Anything relative to AI has been beaten up. And as you can see, the drawdown here was significant. 350 approximately for highs, recent lows in the neighborhood of 160, a 55% drawdown there. Pretty rough. Now, BE Bloom Energy was upgraded at Mizuho today to outperform from neutral and a target at 242, which is actually down from previous target of 285. The company reported a strong quarter with revenue and shipments that beat expectations, according to the analysts in their investor note, that says that Bloom is operating. Their operations are materializing faster than expected amidst their own margin expansion. So that was a positive. Now, we're also going to be hearing from a little company known as Apple today after the bell. And Apple's chart, I mean, just made a new 52-week high yesterday, intraday. Great, and not just 52, that's an all-time high, of course. And it's a beautiful chart, all things considered. We were watching the potential for a break through the resistance here, and we got it. And not only did we get it, we've maintained it. So we broke out, built a bull flag, broke the bull flag to the upside, and are now just pulling back to the possibility of the 20-day, maybe even down below. Again, that 315, a very important level for Apple. But let's look in our final 2 minutes here at how Apple is appearing in the option chains. Oops. Let me change that to yellow, apparently. I'm on yellow. So there we are, Apple. All right, so let's go to eliminate. There we are. All right, so now I got all my contracts. Tomorrow is the 31st. We have earnings after the bell. Here is our implied volatility and expected move. We're looking at about $11 move, almost 12, one way or the other. We don't know if we're going to actually achieve that move. Of course, it could go. It could go 12 one way or the other. It could go double that one way or the other, or it could not. It doesn't have to move, obviously, right? We don't know. But this is an interesting discussion nonetheless, because I like to look at what 12 points either direction means. And if you look at where we've been, 12 points basically means we could get back to prior highs, or 12 points below us means that we could be somewhere in the neighborhood of 318 based on the current price, right? And 318 would be below the 20-day, but holding horizontal support. Now, it's also notable that we have a bearish divergence here. In fact, you've got 2 points of bearish divergences. The last peak here with the bull flag, and then the last high we made just yesterday, both reflecting lower highs in RSI. Now, it's difficult to use that as a mechanism for anticipation for tomorrow or late today when they announce, but nonetheless, I just wanted to give you all a brief synopsis of what maybe traders are monitoring with Apple here heading into the earnings after the bell today. All right, and with that, Wow, went fast. Yeah, we're at time. I did see. I wanted to say that Gary, you mentioned that August is still summer. It's not over yet. My kids would balk at that. They agree it's not over yet, but boy, are they displeased because it is right around the corner. They get started. I think school gets kicking up again in 10 days or something like that. It's just not. It doesn't feel like the summers are as long as they were when I was running around and enjoying my time on bikes and in pools and whatnot. But nonetheless, I'm looking forward to the fall because that means it's fall food time. And as Ben and I often will discuss, that means good food weather. We love our crock pots. We like our stews, our chilies. All of that stuff is coming, everybody. So fall food is right around the corner. Could not be more excited. So we're gonna wrap it there, everybody. Ben, thank you so much, buddy, for being here. Obviously, love having Ben in the chat. Remember to follow Ben and me on X, Ben Watson CS, Kevin Horner CS, and don't forget to say hi. If you're going to be in Dallas this weekend, Ben and I will be there for the market drive on Saturday morning. Would love to see you there, of course. If you're in the area, make sure you stop by and do that. And as always, subscribe to the channel here. I get this one reviewed and into the archives for you a little later, and your thumbs up down below if you like this segment will help me out quite a bit. So always appreciate you joining and participating, everybody. I will not be on with JB tomorrow for Trader Talk, but I will be here Monday morning for all of you. So have a great rest of your Thursday, a wonderful weekend, and let's catch up again real soon.